Getting stock shorting explained is important for short selling strategies and a must-know for my stock market course. It is important for knowing the specifics of shorting a stock and if a short squeeze is going to happen. I do have to warn you that these are risky moves for any investor who doesn't have experience. Shorting stocks can have its benefits, but I'll let you be the judge of that. Let's not waste any more time and let's get into this. Welcome to our financial future. This is a channel designed to build a community of investors so we can all reach our financial freedom. If you're new here, I have a 7-hour stock market course in my playlist that covers the details of some of the most valuable investing guidance. Be sure to hit that like button along with the subscribe button so you can get more updates as they come out. Sometimes when companies are in rough positions, people want to try and profit off their possible shortcomings. It's unfortunate if you are a shareholder in one of these companies because the stock price can get pushed down because of short selling that's going on. Sometimes though, if a stock is heavily shorted, then you could experience what is called a short squeeze. And I'll explain what that is further into this video. Short sellers profit off stocks moving downward, but exactly how are those profits made? We know a traditional long position, you're able to profit off buying low and selling high. Shorts, on the other hand, make profits off selling high and buying low. Now you might be thinking, how do you sell a stock before you own it? The first step in doing this is opening a margin account. A margin account acts as collateral because you are going to borrow the stock from your broker, sell it, and then buy it back when the price goes down. You'll then return the security and keep the price difference. Maybe you have heard someone say, buy high and sell low. Well, this would be in line with that strategy. Returning the stock to your broker is known as covering your position. If the stock goes up, then the money in your margin account covers the losses you incurred, but your broker will enact what's called a margin call. Unfortunately, if that happens, you're going to have to add more money into your margin account if you want to keep that position open. You have to have at least 50% of your initial position in your margin account, and this is quite different from going long, where you spend 100% of your initial money on your position. Let's go over an example. Let's say you shorted 100 shares at $10 a share, equaling $1,000 in total. You would have to have 50% of that in your margin account, which would be $500 to borrow the shares a short. If the stock goes to $5 a share, then you would profit $500, but on a percentage basis, you made 100% return. This is because you only had to put $500 in your margin account, but your total investment was $1,000. This is different than a long position. If you were long 100 shares and it went down to $5 a share, then you lost 50%. The risk with shorting is that a stock can go up an infinite amount. This means if you are shorting, you can lose an infinite amount of money, and sometimes stocks can go up pre-market on sudden news. This leaves you in a tough position because you can't trade until the market is open. Usually traders try to hold these positions for short term instead of using them for the long term. You could essentially short something like the S&P 500 waiting for a stock market crash. You could be in that position a long time and the market is unpredictable, so be careful. With shorting, you are essentially using leverage. The gains and losses are amplified in both directions, which can be dangerous for new investors. If the stock in the previous example went up to $15, then the long position gains 50% of his initial investment, but the short position would have lost 100% of his initial investment. Now, if this person shorting the stock is losing money, this can trigger what's called a margin call, and they will have to put more money in their margin account. Also, if the stock pays a dividend, then you will have to pay the amount to your broker. Since we're borrowing the security, you will also have to pay interest on that loan. This is just like if you are taking a loan from the bank, and the more volatile the stock, then usually the more interest you will have to pay because of the risk involved with that security. Micro cap and small cap companies can easily see their share price go up 50 to 100% in a day on some good news, so be careful with what you short. Now let's get into the basics of a short squeeze. As someone going long on a stock, this is the part you enjoy the most, watching the price go up. Like I said at the beginning, a short seller is just borrowing the stock from your broker. Your broker had to take those shares from someone's portfolio or have purchased them themselves to lend them out. This could even be shares from your portfolio. If you are a short seller, your broker could ask for those shares you borrowed back at any time, which is risky if you are going short. There could be multiple reasons why your broker would ask for those shares back. The stock could see a flood of new buyers and the broker could need them because of the demand. As a short seller, you could be forced to buy back shares at a lower price or whatever price your broker makes you. He could ask for shares back even if you are losing money on your current position, forcing you to cover at a loss. Since you have to buy the shares back, you are essentially adding to the current momentum of buying in that stock you are shorting. This is what makes the stock price increase in value so rapidly in a short squeeze. The shorts are essentially getting squeezed out of their position because the price is going up, which makes them have to cover and their broker want their shares back. The most recent short squeeze was GameStop. GameStop was considered the blockbuster of the gaming world. The stock was heavily beat down and was a struggling business. You can go over to Yahoo Finance and click on statistics. This will show you what percent of the float and shares outstanding is shorted. Anything that exceeds 40% of the float shorted would be high and represented as a bearish signal around a stock. When heavily shorted stocks experience some positive momentum, then the shorts have to cover, adding to the buying frenzy. This in return pushes the stock price up higher, forcing more shorts to cover, which causes more buying, which causes the stock to go higher, which causes more shorts to cover. Looking at GameStop, we can see this stock was around $3 to $4, and in a quick amount of time, it went to $35 due to a short squeeze. Now, if you looked at the price, it went sky high and has crashed. Short selling can actually push the stock down because you are borrowing shares and selling them, which will create selling pressure. And if that exceeds the buying pressure, then this could push the stock down. If there are enough people shorting the equity, then you could see the effect take a toll on the stock price. Shorting companies' stock is an insult to management, and you best believe you are going to motivate them because their goal is to be as successful as possible. If you do choose to short stocks, you're really going to have to understand the stock market. There are certain stocks you might want to avoid when it comes to shorting. Stocks with a low float can cause some troubles when you short them. A low float means there aren't a lot of shares trading. This can be a good and bad thing. If there's a lot of buying, then the less shares that are diluted can cause bigger upswings in the stock price, so make sure you always check for this. I would also stay away from biotech stocks. Biotech stocks tend to take massive jumps, and this can happen when the market is closed, after hours, or pre-market. The reason being is because they usually create a new drug or medical device that is going to create a lot of revenue. Since the gains or losses are amplified, usually these trades aren't worth the risk, and I'm sure you could find another place in the market to find returns. Sometimes bear markets can be good times to short stocks. In the 2008 financial crisis, you weren't allowed to actually short the bank stocks to protect the integrity of the companies, the quality of the securities market, and this was to strengthen investors' confidence. Very interesting, but a necessary approach. But I wouldn't expect this to happen to any other stocks you own, as this was a special occasion. If you do plan on shorting individual companies, then going over their financials is a good place to start. Is their revenue starting to decline? Maybe their gross margin is going down as well. Their operating costs could be going up, or they are taking on lots of debt on their balance sheet. Maybe the company isn't profitable and you don't see a path forward for them in their industry. If they have some of these characteristics and you think their stock price is high, then maybe this stock is worth doing more research on. Sometimes if you think companies are overvalued, then you can try and time when to jump into a short position. Now, this can be difficult to do. The current market we are dealing with doesn't make too much sense. It seems like it's being driven by tons of stimulus money, and a lot of growth companies are benefiting from this. Take Tesla, for example. Tesla, in my opinion, along with a lot of others, has been overvalued for a while now. Some people have shorted the stock and have gotten crushed. You really want to be careful about the stocks you choose to short. The famous Michael Burry from The Big Short is now shorting Tesla, and I'm interested how this turns out. If your thesis is that you expect a certain industry to start to fall, you might want to short that specific industry. Maybe you think restaurants or certain parts of the tech industry will start to do poorly. You could actually pick out an ETF and short that. There are also inverse ETFs that are correlated with the price movement of a certain ETF, which is another approach you could take. Inverse ETFs aren't long-term investment vehicles because they aren't built like stocks or perform like shorting an ETF. The advantages of them is that they won't need a margin account like if you were going short on an ETF. You will have to decide what is the best approach for you. Just like how you have to pay the dividend if you're shorting a stock, you're going to have to pay out the expense ratio if you're shorting an ETF. You could also play leverage inverse ETFs, which could pay you double or triple your investment, or vice versa, lose or double or triple your losses. These products are very risky things to play with, so I suggest you really do your research before you start looking into the types of investing avenues. In this video, I gave you the mechanics of how shorting stocks work. I went over the risks in shorting stocks. I explained what a short squeeze is and what to look for. I talked about some ETFs and inverse ETFs, and I also went over some examples of bad situations that you might get in if you decide to short stocks. I hope you enjoyed this video, and I'll see you in the next one.